Now, certain organizations obviously require some type of decision making in different types of situations. Now, with respect to the managerial accounting, or we may say that with respect to the production, what are the major decisions to be taken? We have to see for that. Let's suppose the raw material or the production capability, production capacity of any organization is not enough, and the organization have to have got greater orders. Then obviously uh, they will fulfill these orders with some alternate means or alternate methods by contacting some other manufacturers and then getting it done by them. So they will quote an offer for the organization as well. So the first decision making scenario would occur is that accept or reject an offer. Whether a third person has the offered the raw material or the product for the cost, whether for the organization that is acceptable or not. That is accept or reject an offer. Secondly, that is similar to the first one, that is it is choice between the two alternatives or two offers. And third one is obviously in the break even we have seen that if organization has two or three product lines, or if one product line is having is suffering a losses, then the organization would decide whether to continue that product line, whether to continue that product segment or business activity, or whether to discontinue. It is a major decision making in the manufacturing organizations. So there would be whether continue or discontinue. A product, it can be anything. Continue, discontinue, a product, department, even a segment, or even any business activity. Another decision making is pertains to the maximization of profit. Obviously, profit, the aim is to maximize the profit and simultaneously to minimize the cost expenses. But in this target, some organizations are faced with the problem of the limiting factor. This limiting factor can be anything: the available manpower, the available uh, units of the raw material, all the available kilowatts of electricity, available production capacity. So limiting factor depends on the scenario, and with that limiting factor, the organization have to produce, and the simultaneously the aim is to the maximization of the profit and minimization of the cost. Similarly, another thing that is related to one again is make or buy decisions. It happens many times that if we decided to make something in house, that may cause us some heavier expenses, and if we go for the market and search for that product, we may found them less costly than our production cost. So in that scenario, buying the material, buying the product from the outside organization would be better. So now we have to see the calculate through calculations whether we have to make the thing, or we can purchase it from the outside and then we can give to our customers. Then product mix decisions. Then capacity decisions, whether to run at full capacity or not, or how to maximize the capacity. Then pricing decisions. It is one of the important factor decision. Then decision for launching a new product, when to launch, where to launch, how to launch. Are you getting these things? Clear? Any issues?
No.
Similarly, capital decisions. This is a separate topic, capital management decisions. In any of your course, have you studied the present value, future value, and net present value like this?
Yeah, in economics.
In economics,
Yes.
present value, future value, formula, and problems relating to this, or just know-how, just a little bit of theory.
No, I think I remembered that we did some problems as well.
And have you calculated full-fledged, done full-fledged questions of calculating net present value as well?
I don't remember about that. It was a while ago.
Basically, it is financial management. I don't think so that you have studied in economics. And have you ever studied any business math type course? Present interest like simple interest, compound interest, and future values, present values, NUT.
Yeah, I've studied those. Yes. This was in economics because of the interest on, loans and everything.
Okay, we will see for that. Okay, now these are the some aspects that needs decision in the organization, and how these decisions are taken. Obviously, there are some methods, tools, techniques for that. From 1 to 4, the problems with these decisions. 1 to 4, the major decision is taken on the basis of contribution margin, CM basis, because fixed cost is fixed, whether we make or buy, whether we continue or discontinue, the fixed cost will be incurred. Therefore, the major thing is that we have to see the CM, that if we want to take the decision about continue or discontinue, if we see that one product is not contributing enough CM, then we can decide to discontinue it. Even if one product is having a losses, but it is contributing a good towards CM, then we can continue it. So these decisions are taken on the basis of CM. Make or buy decision is taken on the basis of cost basis. Obviously, we will see cost, the cost of production and the cost of purchases. Then pricing decisions are also taken on the basis of CM. And the product mix decisions, capacity decisions, they follow a mixed procedure. We have to perform certain calculations as per the given situation. Done. Now, in overall these decisions, while taking these decisions, there are 3 to 4 types of tools, techniques that can be applied, that can be beneficial for taking these decisions. So tools or techniques. Very familiar. We have done this earlier. Number 1 is CM technique. You should know how to calculate CM. Number two is variable cost technique. Now there is a difference between CM technique and variable cost technique. Can you explain, elaborate what's the difference between CM technique and variable cost technique?
So basically in the CM technique, you calculate the CM, which is sales minus variable cost.
Mhm.
But then the variable cost technique doesn't include, the CM. You just basically find.
Which is basically contribution margin technique is, yeah, I am elaborating here. You have said it right. Basically, contribution margin technique tells us how much return we are getting in sort of. But in variable cost technique, there is only the subject matter is only the cost. How much the variable cost is being incurred or how much the variable cost is being saved. So this is the difference between the return and the cost. Clear?
Yes.
Okay, number three would be differential or incremental costing. Differential or incremental costing means how much extra I have to pay. Let's suppose I have to pay $100 for one material, and the other or for buying from the market, I will see how much extra I have to pay. And if I am paying extra, did I getting a return, sufficient return for it or not? This is what known as the differential or incremental costing. We will see it in our practical questions as well. And the number four technique is the linear programming. I am sure you have done this in some of your courses. Have you done this? Linear programming, feasible region, profit maximization or not?
Is it the linear regression analysis?
No, it is not linear regression. It is basically linear programming. Linear programming is something that it is done through the graph, but we took common areas through the graph where the different cost intersects and where the revenues intersects. Let's see whether it is in your textbook or not, then we will do it. Okay. Now the tools, or sorry, these are the tools and techniques. Now there is something needs to remember in this decision making analysis, that some cost becomes irrelevant in decision making. So we have to see that we do not consider it for our decision making process. That is irrelevant costs. Number one is fixed cost. As we have discussed earlier also, that fixed cost, whether we buy, whether we make, whether we continue, whether we discontinue any product, our fixed cost, that is rent, will be incurred at any cost. So fixed cost, considering the fixed cost that we have saved, so much of fixed cost is irrelevant. It has nothing to deal with our decision making process. Secondly, that is the sunk cost. And we had idea of the sunk cost. Sunk cost means that is the past cost that we have incurred for any product, and they become irrelevant for the future decision making. Sunk cost can be termed as past or historical cost. So these are the costs that are irrelevant for the decision making purposes. Now we will see some practical questions relating to these situations that requires decision making. Clear? First of all, we have to see whether which category our problem falls. Then we have to solve it this according to this technique. Now illustration one. This is the company X company which produce, manufacture and produce and sell single product. And the details of that single product are as follows. It uses direct material per unit $5, direct labor per unit. We have to carefully see whether the amount given in the question is per unit or per 100 unit or is the total that impact our decision making. Is $6 variable FOH is equals to $4 is FOH is equals to $5. In this way, our total manufacturing cost amount to $20. The organization add a profit amount, profit percentage, profit per unit of $5. So in total, the selling price will become $25. Now, what is the issue? What is the situation? The company received an offer from an overseas customer for the supply of 10,000 units at $17 each. The company have surplus capacity to meet this offer. The required is should offer be accepted or not. This is the situation, this is the question. Now you are getting this that we have given this data and the company has received an order of 10,000 units at $17 means the organization will be selling it. Are you getting this point? Organization will, in normal circumstances, the organization usually sell the product at $25 per unit. But that customer has bid or the company has received the order for the supply of 10,000 units at $17. Apparently, it seems that there is a difference between $25 and $17. So it would be whether we can say that it is not a favorable situation for the organization that to supply it at $17. But the thing is that the company have surplus capacity. This is the key issue. Company have surplus capacity. It means after meeting this regular requirement of customers and selling it to the $25, the organization can still produce some products and can meet this requirement. So now we have to see whether this should be accepted or not. Maybe if this amount seems lesser for the current situation, maybe in order to capture the foreign market, this is because of overseas customer. So maybe to capture the foreign market, or to make it a regular customer in future, and later on they can increase the price as well, because the customer will be satisfied and he will give then any price which is maybe charged. So keeping in view of these circumstances, we have to see whether this offer should be accepted or not. Yes, company do have some limitations, companies do have some calculations to do. On the basis of that, we have to see whether this offer can be accepted or not. Now, as we have discussed that this situation pertains to number one situation, that is accept or reject an offer. And 1 to 4 decisions are taken on the basis of what? CM. So we have to see the CM, just CM, how the new offer can be contributed, or if the CM is even positive, it means this offer is giving something to the organization. Are you getting this point? The whole situation.
Yeah.
So if we calculate the CM on the basis of this selling price, so solution, what we do is we have to calculate CM, and CM is, in this situation, sales is 17 per unit. And
Yeah.
variable costs are, these are the variable costs. They are total of 50. Hello.
So wait 1 second. How
Sorry.
is it 15?
Isn't it 15?
How
Six.
is it 15? Shouldn't it be 4?
5, 6, 11, and 4. Total variable cost. If organization, are you getting this or not? Hello.
1 second. I'm confused why the variable cost is equal to the managerial.
Why? What is the confusion basically?
So we know that manufacturing cost is equal to direct material plus direct labor plus variable FOH, right?
Yes.
So here you said that the variable cost is 15. 15
Yes.
is equal to the manufacturing cost.
No, it is not.
Really?
We are taking the CM. And for CM, we
Yeah,
are,
but for the CM, you need the variable cost. And why is the variable cost 15 and not just 4?
your concepts are again rusty. Direct material is variable cost, direct material variable cost, direct labor variable cost, and variable FH variable cost. They are 5, 6, and 4. The total 5, 6, and 4 will becomes what? 50. So I have written here total variable cost.
Oh, okay. Yeah.
Oof. Then CM is 2.
Yes.
Clear? Okay. Then CM is 2. And at this CM, because we have surplus capacity, fixed overhead will be no issue. And selling by manufacturing 10,000 units and selling it at 770, we will incur 15 of the variable cost, and we will get 2 per unit of CM. And the total of CM would be 2 into 10,000 would be 20,000, would be the extra profit for the organization. Extra CM for the organization, given the fixed overhead is same. So in this decision, we can write it like this, that there are two things. We can write in one simple thing, that is, since CM contribution is positive, just like NPV. If NPV is positive, we can accept the project. We can undertake the project. So since CM is positive, the offer should be accepted.
Accepted.
Done?
Yes.
This is the basic question of CM, and you get confused in the CM. Okay, now illustration 2. Now, ABC company producing and selling two products. And those two products are X and Y. Now details: direct material $8 and $5 per unit. Direct labor 7 and 6. Variable overhead 5 and 3. Fixed overhead 4 and 3. So this total would be, I guess it is 24. Can you recheck it, please?
Yeah, it's 24.
And it is 17. So the profit element is 6 and 4. So the selling price would be 30 and 21. Simple as that. Now what is the issue? The company received two offers from two customers. Two offers from two customers. They are foreign customers, it is understood. And they have offered two products. Product Okay, now the situation is that, just understand this, that now those two customers have offered to sell them. One of them has offered to sell him X product, and another has to offer to sell him the Y product. So the one has offered X product 10,000 units at $22 per unit, and another has offered product Y 15,000 units at rupees $1.20. Sorry, $1.16. Now issue is that these two requirements cannot be met with the existing capacity of the organization. So the organization can accept only one offer because of capacity constraint. So only one offer can be accepted due to capacity constraint. Now you have idea that what is the requirement. Requirement is that which offer should be accepted and which should be rejected. Which offer should be accepted. So basically it is also the rejecting or accepting the offer, and Now it is basically between choice between two alternative or offers. Means we have to offer accept any one offer. But again, the basic technique to solve is the same method, and how these offers can be evaluated and which offer can be accepted. Can you calculate this? Have your say.
Yeah, yeah, I'll do that.
Okay, okay. Then do this and let me know your decision. Which offer you, as a cost accountant, as a manager, costing, or accept.
Okay. So they should choose product Y.
How?
Um, okay, so for X, the sales is 220,000, and then the variable cost is 200,000. So the CM is 20,000. But for product Y, the sales is 240,000, and then the variable cost is 210,000. So the contribution margin is 30,000.
So
Contribution margin for Y is greater.
okay, done. But we can see also, we can see that yes, contribution margin for Y is great. Done. So on the basis of that, we will accept which offer?
Y.
Product. That's great. Again, now the another situation. Illustration 3. We have been given a three products: A, B, and C. Details are sales. Now they are in full amount. Dollar 500,000, 300,000, and 1 million. Cost of goods sold is total. Cost of goods sold total for 30,000, 380,000, and 750,000. And now you can see that the net profit or loss would be 70,000, profit, 80,000 loss, and 250,000 profit. Now the issue is that the board of directors or the management is concerned with the poor performance of product B and want to discontinue. But some of the gentlemen or some of the you may say management team say that no, it shouldn't be discontinued. Overall, it is contributing to the profit, or that is, it may get good in the future. Now, have your say what it should be. Should an organization continue this product, whether required is whether product B should be continued or not? Can you do this? Hello,
Yeah, sure. Can you give me a hint on how to do it?
this is the hint. This is the only hint. Just see whether in which category your this decision making falls. It is continue or discontinue
Contribution margin.
on the basis of contribution margin. Yes. Start.
Sir, I could calculate the CM by finding out what's the
Why?
variable cost. But here in the cost of goods sold,
Yes.
uh,
You should be.
there's not much information given for the cost of goods sold, like what contributes to it.
Means you are saying that the question is wrong.
No, but
Then there must be.
am I missing something?
Yes, yes, obviously, concept missing. There must be some way to calculate it. Okay, there is alarm going on and there is a less than 1 minute. Just think over it. I will join back. Okay. And if you want
Yes.
to take the picture of this question, you can.
Yeah, 1 second.
Done?
Yeah.
Okay, we'll be back in 2 to 3 minutes after this recording is converted.
Yes.